KeyCorp absolutely crushed consensus this quarter.
Yeah, they really did. Just a massive beat across the board.
Right out of the gate, total revenue hit $1.964 billion.
Which is a solid 7% increase year over year.
Exactly. And earnings per share, EPS came in at 44 cents. I mean, that is a whopping 26% jump.
It's huge. And they didn't just beat on the current quarter, they actually raised their full-year guidance significantly.
Right, which is exactly why the stock completely popped right after the report dropped.
The market absolutely loved it.
Oh, for sure.
Oh.
So look, usually when you open up a bank's quarterly earnings report, it's
just a wall of numbers.
right, a giant drywall of spreadsheets and basis points. But today, we're going to look under the hood of this $191 billion legacy bank to see exactly how they pulled this off.
Yeah, because our goal today isn't to just, read a list of revenue numbers at you. We want to actually help you understand the mechanics of this strategy.
Yeah.
And by end of this deep dive, you're going to understand this concept of operating leverage. You'll see how a major bank can somehow increase its profits massively, even while it just sits there and watches its bad loans go up.
Which sounds completely counterintuitive.
It really does. It's basically a masterclass in balance sheet management.
Yeah, I'm so excited to get into it. So looking at those headline numbers again, net interest income, which is, the core way a bank actually makes money.
Taking in deposits, lending them out.
Right, exactly. That hit $1.258 billion, up 9%. So why exactly is management taking such a massive victory lap here?
Well, it comes down to something CEO Chris Gorman said in the commentary. He specifically highlighted that the bank generated approximately 130 basis points of operating leverage.
Okay, 130 basis points.
Right. And that phrasing, it isn't an accident. It is like the defining metric of their entire quarter.
Yeah, operating leverage. Whenever I see that term, I always think of it like a massive factory that finally hits scale.
Oh, that's a good way to look at it.
Right. Like imagine you build a factory to make widgets. That very first widget costs a fortune because you had to build the whole building, buy the machine.
Or by the staff.
Yeah, all of it.
Yeah.
But once it's running at full capacity, every new widget costs slightly less to make than the last one. Your fixed costs are baked in.
Right.
So if your revenue is growing faster than your expenses, your profit margin just naturally widens out. That's operating leverage.
That's exactly what's happening here.
But I have to push back for a second because a 26% jump in earnings per share in a single year for a highly regulated regional bank is wild.
Right.
Are they just taking on significantly more risk to get those returns, or did they really tune the engine that much better?
Well, if we connect this to the bigger picture, the data strongly suggests they aren't achieving this through reckless gambling.
Okay.
It's coming from this almost surgical discipline in how they manage their margins. You see this perfectly in their net interest margin, their NEM.
Right.
It actually expanded by 2 basis points sequentially, up to 2.89%.
So they're meticulously managing the spread between what they pay out to depositors and what they earn from borrowers.
Precisely. They are ruthlessly defending that spread, and because they're generating so much excess capital through that discipline, they are just heavily rewarding their shareholders.
Yeah, the buybacks are insane.
They really are. The report shows KeyCorp repurchased $341 million in common stock just in the second quarter.
Just in one quarter at, what was it, an average price of $21.95.
Yep, 21.95 a share. And they aren't stopping there. The board authorized a $3 billion share repurchase program.
Wow.
And management expects to buy back at least $1.3 billion in total just in 2026.
If you are a shareholder, that is exactly what you want to see. I mean, by retiring those shares, the bank is reducing the total number of slices in the pie.
Right, exactly.
So even if the bank's total value stayed the same, your individual slice of ownership just gets inherently more valuable.
Returning capital at that scale is basically the ultimate signal of confidence. They are telling the market, we have more than enough cash to cover our risks, fund growth, and still pay you.
But you can't just wish your way to a 2.89% net interest margin. If we want to track the cause and effect, we have to look at their actual loans and deposits.
Yeah, this is where the story gets really fascinating.
It's essentially a tale of two entirely different loan books moving in opposite directions. So average loans overall grew by $2.3 billion in the quarter.
Right, up to about $110 billion.
But that growth wasn't just a rising tide lifting all boats. It was entirely driven by the commercial side. Their commercial and industrial loans, the C&I loans, jumped by 5%.
And the necessary context there is what happened to the other half of their business, the everyday consumer loans.
Yeah, they dropped.
They did.
Yeah.
Average consumer loans declined by 1.9% quarter over quarter. And this is critical for you to understand. This wasn't an accident. This wasn't KeyCorp losing market share because of a bad marketing campaign. The presentation explicitly calls this an intentional runoff of low-yielding loans.
Here's where it gets really interesting. I look at this intentional runoff like a busy, super popular restaurant that suddenly decides to take all the cheap appetizers off the menu.
Okay, I see where you're going.
Right. They aren't doing it because people stopped ordering the appetizers. They're doing it because those cheap orders take up physical table space and kitchen bandwidth.
And you want to save that for the high-paying customers ordering the expensive steak dinner.
Exactly. KeyCorp is looking at low-yield consumer loans, like an auto loan, and saying, we don't want this taking up space on our balance sheet, just let it expire.
Yeah, they're just walking away.
But I have to ask, by intentionally letting consumer loans just run off, isn't the bank alienating its everyday retail customers? Aren't they sacrificing future relationships for a short-term bump?
It's a very logical concern, but KeyCorp's strategy relies on a fundamentally different kind of relationship building. They are leaning heavily into corporate ecosystems.
Okay, what does that look like in the numbers?
Well, the report notes that approximately 91% of their commercial loans are made to clients who do additional business with Key.
Wait, 91%? That is massive.
It is. It means they aren't just, handing a mid-sized corporation a loan and checking back in a year.
Right.
They are providing investment banking services, managing corporate treasuries, handling all their commercial payments. It's about relationship density over sheer volume.
So if you capture the entire financial operation of a company, that client becomes incredibly sticky.
Exactly. You become indispensable to them.
I see. So they want the steak dinner customer, but they specifically want the customer who is also going to buy the expensive bottle of wine, order dessert, and book the private dining room for their next corporate event.
That's a perfect way to frame it. And the strategy flows perfectly into how they fund these lucrative loans, which is through their deposits.
Right.
While they are intentionally letting consumer loans run off, total deposits actually grew slightly to $147.6 billion. But here's the crucial metric for their operating leverage. Their deposit costs actually fell by 2 basis points down to 1.63%.
Let me stop you right there because the math on that feels contradictory. Total deposits went up, meaning they have more money in the vault, but the cost to hold those deposits went down.
Yep.
Mathematically, the only way that happens is if they are bringing in a massive influx of cash that they don't have to pay any interest on at all. Are corporate clients really just parking billions in zero-interest checking accounts?
They absolutely are. And it goes right back to that 91% relationship density. They saw a 2.3% growth in average non-interest-bearing deposits.
Wow.
Because when you are the primary bank for a major commercial borrower, they hold their operating accounts with you. They have to keep massive amounts of liquid cash to run payroll, pay vendors, manage the supply chain.
And the switching costs for a corporation to move its entire payroll operation to another bank just to chase, like a 4% yield on their cash, is an absolute nightmare.
Exactly. The administrative burden is just way too high. So the corporation accepts zero or near zero interest on those accounts for the convenience of having everything under one roof.
Which gives KeyCorp incredibly cheap, highly stable funding.
Exactly. And when your funding costs drop while your commercial loan yields rise, that directly expands that net interest margin we were talking about earlier. It's a beautifully designed system.
Okay, so the engine is perfectly tuned. They are locking in corporate clients, securing cheap deposits, and letting low-yield consumer debt fall off. It makes perfect strategic sense.
It really does.
But no engine runs perfectly forever, right? Especially when the macroeconomic road gets bumpy. If they're pushing this hard into the commercial space, we have to look at what happens when borrowers hit a wall.
Right, the credit quality.
Yeah, because usually, if bad loans go up, a bank hits the panic button. But KeyCorp did the exact opposite, and it brings us back to that massive paradox I mentioned at the start of this deep dive.
It is definitely one of the most striking parts of this entire report. First, net charge-offs, which is debt the bank has officially given up on, rose to 32 basis points of average loans.
Up 4 basis points sequentially.
Yep. But the bigger number is the non-performing loans, the NPLs. These are loans where the borrower hasn't officially defaulted yet, but they have stopped making payments.
Okay.
Those jumped a massive 18.6% in a single quarter to $809 million.
An 18.6% jump in 3 months is a huge red flag. I mean, that now represents 0.73% of their total period-end loans.
Right.
Normally, when delinquencies are rising at that pace, you see a bank aggressively padding its reserves. They start building a fortress against the incoming wave of losses.
But they didn't do that.
No. KeyCorp's provision for credit losses was only $92 million for the quarter. And even crazier, they actually recognized a reserve release of $23 million.
Right. And for those who might not follow bank accounting daily, a reserve release means the bank actually took money out of its rainy day fund and recognized it as income.
Which is wild.
They looked at their models and determined they had actually over-reserved for future losses. Management specifically attributed this to resilient economic scenario assumptions and the improving mix shift of commercial loans.
So what does this all mean? Because I really have to challenge this logic. If non-performing loans just jumped by over 18%, how on earth can management justify taking $23 million out of their safety net?
It does sound counterintuitive.
Right. If you're a listener thinking about this logically, it sounds like canceling your car insurance the day after you get into a fender bender. Are they just being dangerously optimistic here to juice the current quarter's earnings?
It looks like dangerous optimism on the surface, but what's fascinating here is the underlying structural composition of the assets they're holding on to. It all goes back to that pivot away from the consumer. The bank feels entirely insulated from these rising defaults because of the specific, highly defensive quality of the loans they are keeping.
Give me an example.
Well, 57% of their entire commercial and industrial portfolio is rated as investment grade.
Okay, let's unpack why investment grade matters so much in a default cycle.
Yeah.
They aren't lending to risky, cash-burning startups. They are lending to established heavyweights.
Exactly. When you lend to an investment-grade corporation, you are lending to a company that has multiple levers to pull if the economy turns south.
Right.
If a mom-and-pop store runs out of cash, they just default. If an investment-grade corporation runs short on cash, they can issue bonds, they can tap international capital markets, they can restructure.
They have a massive runway before they ever default on their bank loans.
Exactly. So KeyCorp knows that even if a few of these loans are currently marked as non-performing due to delayed payments, the ultimate risk of total loss is incredibly low.
And what about the consumer side? Because they obviously still have a consumer portfolio, even if they're letting some of it run off.
The consumer book they do still hold is incredibly prime. The report highlights that their consumer book boasts a weighted average FICO score of 766 at origination.
Wow, a 766 FICO score is essentially a borrower with bulletproof credit.
It really is.
If you're looking at why that acts as a structural moat, I mean, a borrower with a 766 score usually has significant home equity, steady employment, often dual household incomes.
Yep.
They might feel the pinch of inflation, sure, but they are the absolute last people to default on their debts because they have way too much to lose.
Precisely. So while defaults might be ticking up on the margins across the broader economy, management trusts the structural quality of their remaining assets far more than they fear the current delinquency trends.
Right.
They believe the fortress they've built with investment-grade corporate debt and 766 FICO consumers is strong enough that they don't need to keep adding bricks to the wall.
Hence, they felt perfectly safe executing that $23 million reserve release.
Exactly.
That is a staggering amount of confidence in their own underwriting. And that confidence isn't just cheap talk on an earnings call to appease analysts. They actually wrote it in ink into their forward-looking guidance for the rest of the year.
They did indeed. They raised their full-year 2026 guidance across several very important metrics. They now expect net interest income to be up 9 to 11% for the year.
Which is a very meaningful increase from their previous guidance of 9 to 10%.
Right. And they also bumped up their expectations for average loan growth, moving it from a 2 to 4% range up to a 4 to 5% range.
And when you look at where that loan growth is coming from, it completely validates everything we just talked about regarding their pivot. They project average commercial loans will jump by 8 to 10% for the year.
Up from previous expectations of 6 to 8%.
Right. They're essentially placing all their chips on the commercial sector while putting the consumer side on autopilot. You can see this visibly in the segment performance, too.
Yeah, the contrast is stark.
The commercial bank brought in $423 million in net income this quarter. That is more than double the consumer bank's $203 million. Plus, their assets under management hit a record $74 billion.
Which raises an important point about how they're navigating the broader macroeconomic environment, particularly with interest rates.
Okay, how so?
This raised guidance reflects a bank that has successfully managed the high interest rate environment and is prepared for whatever the Federal Reserve does next.
Right.
A key metric they highlight is their cumulative down interest-bearing deposit beta, which is sitting at approximately 56%.
Oh yeah, let's translate that bank speak for the listener. This measures how much of a central bank interest rate change is passed on to depositors, right?
Yep, exactly.
So a 56% down beta means that if the Federal Reserve cuts interest rates by 1%, KeyCorp has the immediate flexibility to slash the interest rates they pay out to their depositors by more than 0.5%. They capture that spread instantly.
Exactly. You've hit on their ultimate defense mechanism. They have the flexibility to lower their funding costs rapidly in a declining rate environment.
Which aggressively protects that net interest margin.
Yes. Because they've secured so many of those sticky, relationship-driven commercial deposits we talked about, they aren't forced to pay exorbitant rates just to keep cash from fleeing the bank. They aren't playing defense anymore. They are purely playing offense in the commercial space.
If you're listening to this and wondering why you should care about KeyCorp's internal deposit beta or their commercial loan growth, it's because this guidance isn't just a corporate vanity metric.
No, not at all.
It is essentially a massive bet by smart money. KeyCorp is looking at all of their internal data, viewing the entire economic landscape, and signaling that the commercial sector is where the economic resilience lies for the rest of 2026.
Right. They are looking at the economy and saying, we believe corporate America is strong and we are going to fund it. And their 12.9% return on tangible common equity, which is up 180 basis points year over year, proves that this commercial-first strategy is highly lucrative right now.
Absolutely.
They're generating fees, keeping funding costs incredibly low, and lending exclusively to high credit quality borrowers.
It really is a masterclass in strategic discipline.
Yeah.
We started this deep dive looking at a 26% jump in earnings per share.
Yeah.
And now we see the massive machinery that made it happen.
It's all connected.
It's expanding margins through operating leverage, returning a massive amount of capital to shareholders through that $1.3 billion buyback plan, and ruthlessly shifting focus from low-yield consumer debt to high-yield commercial lending.
It is a deeply disciplined strategy for KeyCorp. But, if we zoom out and connect this to the bigger picture, it leaves us with a rather profound structural question.
What? What's that?
KeyCorp is intentionally letting its consumer loans run off to focus almost entirely on businesses and high-net-worth ecosystems. If other major regional banks look at these earnings, see the incredible operating leverage, and decide to follow this exact same playbook, who is going to step in to finance the everyday consumer?
Well, yeah.
Are we heading toward a future where traditional, highly regulated depository banks are exclusively operating for corporations, leaving everyday people to rely entirely on less regulated fintech apps and alternative lenders for their basic credit needs?
That is a fascinating and honestly slightly unsettling thought to leave on. As the big banks move up market to chase operating leverage, the vacuum left behind at the consumer level is absolutely going to be filled by somebody.
And it might not be the traditional bank on your corner.
Exactly. Well, thank you for joining us on this deep dive into KeyCorp's Q2 2026 earnings. If you want to keep questioning the numbers behind the news, be sure to follow the show for our daily earnings coverage. We'll see you next time.